All right. We are back together, at least, not in the same place. But yeah, we're probably going to be doing these remote for, I don't know, the near future. It was such a, I don't know what to call it, such a, I don't want to call it a burden, but it was hard to get us in the same place, same time every week and be able to do it in a room and all that kind of stuff. And I feel like a lot of podcasts now, they're fine doing it this way. Hopefully you guys watching it are fine with us doing it this way. You're going to get the same information. That part isn't going to change. A lot of times it's harder because for us to have conversations like we did when in the same room feels a little different, but we'll work that on our side and be a little bit more chatty. Or maybe you don't like to chat and maybe you just want to hear Jerry talk.
Well, I think the back and forth is good, and it's definitely going to be good on this one, because when I get to the second part, there's some things to think about in terms of TSP. We talked about this quite a bit before, that a lot of people in the Facebook group and particularly have this kind of CNS ride or die mentality, which I'm not going to try to really push back against. But on this one section that we're going to go through, hopefully it'll give you guys some ideas to think through about what it actually means to be a TSP investor, and what do you expect to do with that TSP savings in your retirement. So we'll get to that in a minute. But TSP Weekly Podcast, 24 August 2025. So we'll take a look at this week's highlights in terms of some of the economic things that happened. It was a really quiet week until Friday. Friday was pretty interesting because the Fed chairman came out and basically told the market that he was going to do a rate cut in September. And that's why the market took off on Friday. But like I said, we'll take a look at that. We'll take a look at what the overarching goal of TSP investing ought to be. And then a couple of big picture macro inputs, and then the general TSP fund direction. So this week we had rates, right? We've been talking about this now for a few weeks. Rates paid on Treasury bond auctions continue to fall, right? Across the board. So we had a 3-month, a 6-month, and a 20-year bond auction this week. All of them sold at lower rates than they had previously, which basically means the lower that the government has to pay, the lower rate that the government has to pay to sell its bonds, the less that we're contributing to the deficit. So we want to sell bonds at the lowest rate, the lowest yield that we can. And that's been going in the right direction for the past couple of months. 30-year mortgage rate rose a little bit to 6.68 from 6.67, and new mortgage applications fell. Pretty much flat, not a huge deal there. Initial jobless claims spiked this week. There was a lot of talk about that, spiked to 235,000 from 225,000 last week. If you go back and look year by year, it's pretty consistent. It's really the decrease in seasonal summer work. And so it's very likely that spike that we saw this week is going to pull back next week, and then continue throughout the fall. And then the big economic news of the week, without a doubt, was Friday. The whole Fed had been in Jackson Hole, Wyoming for the annual Jackson Hole Symposium. Friday morning at 10 o'clock, the Fed chairman did a speech there, and he basically came out and said, there are 2 mandates to the Fed: stable prices, which means inflation, and low unemployment, right? Which means low unemployment. He's in a bit of a trick bag right now because the producer price index came out last week and spiked quite a bit. So it's showing an increase in inflation. And he talked about that in the speech. He acknowledged that there's still a concern that tariffs are going to create this ongoing inflation problem. The other side of that is employment. We had a spike this week in initial jobless claims. And so if that continues, if the initial jobless claim number continues to go up, unemployment is a problem, right? So those are the two sides of his mandate. If inflation goes up, the only way he can combat inflation going up is to raise rates. The only way he can assist the economy to help if jobless claims continue to spike is to decrease rates. So he's in this bit of a trick bag right now. And what he's come down on in this speech is that because the unemployment rate is still historically low, inflation isn't getting out of control yet. He's looking at both of them and weighed in on the side of lowering rates. He didn't say that, but it was implied without a doubt. And that's why the market took off on Friday. So what's going to be really interesting is we're going to get another jobless claims report and another inflation report before the Fed meeting in September. If inflation goes way up, the Fed would look at that and say, I need to increase rates. If the jobless claims number goes way up, the Fed's looking at that and saying, I need to decrease rates. If there's some combination of that in there, there's still a lot of data that's going to come out before that Fed meeting. So it could be potentially extremely volatile over the next several weeks.
Yeah, and I can't remember if I was trying to get my microphone to turn on, and I didn't catch if you already talked about this. But the other thing I thought was interesting about this particular speech. First of all, it's his last one, right? Yeah, his last one, and this is the 5-year mark from when they kind of put their plan. They kind of reevaluate their strategic plan. I'm not sure they call it that, but their strategic plan for the next 5 years and kind of what their guiding principles are going to be and that sort of thing. And this marks, the fifth year. So that means they're kind of reevaluating their stance on things. So I think, sometimes these things can kind of be like, ho-hum kind of whatever, right? Lots of economic data just being spit out there, and nobody really understands what the heck they're talking about. But him being able to kind of have input on the next 5 years on his way out, I think is could be it's a unique thing for him to be able to do. And keeping, I don't want, who knows is going to take his place, and they can come in and just change that if they want to. But, I think you could argue that they've done at least a decent job of making sure that we didn't go completely off the rails after the pandemic. I mean, we could have.
Yeah, I think it's going to be really interesting to see. He's going to go in, I think it's May. And there's another Fed board member. There's some contention between one of the board members and the Trump administration right now. So it's going to be really interesting to see how all this plays out by next summer. The biggest thing, honestly, for TSP investors, the Fed controls what's called the Fed funds rate. And all that is the rate that banks charge each other for lending overnight. It's the shortest on what they call the yield curve. It's the lowest on the yield curve. It's only the overnight lending rate. So the 2-year yield, the short-term yields, tend to correspond to what the Fed does. The longer-term yields, the 10-year yield, 20, 30-year bond yields, those are dictated by the market. So if you remember back last September when the Fed cut rates, the idea was that Fed cuts rates, so the F fund should go up, right? TLT, the long-term bonds should go up, but they didn't move. They actually went the other way, because the bond market was not buying this idea that the Fed's lowering rates. So yes, watching what the Fed does is important for a lot of reasons, but in terms of TSP, the longer term rates are much more important, and the bond market controls that, not the Fed. Okay. So let's kind of go into this idea of the goal of TSP investing, right? If you guys have never seen this movie, it's a classic. Okay, it's called The Gambler, and it's the 2014 version. It's not the Kenny Rogers version. John Goodman and Mark Wahlberg. Okay, so in this movie, Wahlberg they're both gamblers, right? John Goodman is he's lending money to Wahlberg. Wahlberg was up $2.5 million. He was a gambler. He was up $2.5 million. He lost it all, and he's going back to Goodman to get another stake. So Goodman says, and I'm paraphrasing this a little bit because it's probably not great for work or for your kids or whatever. So I'm going to paraphrase it a little bit. You get up $2.5 million. Any idiot in the world knows what to do. You get a house with a 25-year roof, a bomb-proof car. You put the rest in the system at 3 to 5% to pay your taxes. That's your base. That's your fortress of solitude. That puts you for the rest of your life at a level of basically screw you. Somebody wants you to do something, screw you. Boss pisses you off, screw you. Own your house, have a couple bucks in the bank. So what is the point of, why am I talking about this? When you go to retire from your government job or your military job, you're going to have a pension, Social Security, and TSP. Everybody has different circumstances and risk tolerance, right? Really different circumstances in this case. If you can get your pension and Social Security and your TSP savings over the course of your career to get you in a position that you've built your fortress of solitude, right? You don't have to go to work. You don't have to do anything. That's a great position to be in, okay? From there, now that you have that fortress of solitude, now if you want to go get a job in retirement or whatever, take additional risks, you can do that from a place of security. And so why this matters to TSP is that as the market climbs, right, the FOMO that's out there right now is palpable. At some point, we're going to come to a top. Nobody knows when that is. There's all kinds of prognostications and everything else of what happens when we get to that top. But at some point, we're going to get to a top in this long-term rally that we've been in. If you are stuck in that mentality of 25% gains in my TSP every year, and you're basing your fortress of solitude, let's call it, on those continued gains, and you're basing your standard of living and things that you expect to do in retirement on those gains, you probably are going to have a problem going forward. So if you look at it like, okay, this is the amount that I need to have in my TSP to complete my fortress of solitude. Anything beyond that I have in TSP is gravy, right? I'm going to use it to take trips. I'm going to use it to do what I want. But you need to know the amount in TSP that you need to buffer your fortress of solitude. Anything above that, ride or die, CNS, that's awesome. All I'm saying is be conscious of how important TSP is to your fortress of solitude. And it may be zero. It may be your circumstances are great and you can just spend that money in TSP. But if you're not in that category, you just need to think through your risk. Okay? That's all I'm saying.
Yeah, and we talk about this gambler mentality, right? So we're talking about a movie about gamblers, and it's probably one of the most detrimental things that I've seen since we started getting into this business, right? Where we're really working with other people. Like we've always been managing our own TSP account or our own retirement account, but this now, for the last 5 years or so, or longer, we're worried about other people's accounts, and this idea that I should be making X amount each year. I should be like this expectation that the market owes you a certain percentage return is just no different than a gambler walking in and going, I should be able to beat all these people and take the money, right? Okay, but you're probably not every time, right? I mean, the market doesn't care anything about you. The market cares none. And market's going to do what the market's going to do. And the market is a bunch of people. And those people can sometimes be fickle, especially since, there's so much research showing now that there's so many people involved in the market that are retail investors now, right? Not big money, that they have a big impact. So something bad happens, whatever that is, whatever bad means, and everyone expects the market to go down. But a lot of retail investors are very optimistic because there's a lot more young folks in there now, and they're like, hey, I don't think it's going to go down. And so that's kind of a self-fulfilling prophecy. I'm going to buy more. And so it just skyrockets to new highs, and everybody's going, what just happened? And so those things are connected in a way that in your TSP account, if you treat it like it owes me this amount, and when it goes backwards, I should be able to get it back, and all these things, that is a level of risk and a gamble that you shouldn't be taking in your fortress of solitude, right? If you want to be prepared to retire, you need to be more protective of it. You need to be more protective of these downside risks. And that means not just putting it on CNS ride or die. Like, that's not going to work. That's just gambling.
Yeah. There are definitely times, right? There are times in the market when you should be much more aggressive based on what the market is doing. There are other times when you should be much more conservative. But the biggest thing for the individual TSP investor is to know what level of your TSP account you can risk before you are adversely affecting your what you want as your fortress of solitude.
I concur.
All right. So a couple kind of big picture things to stay on that idea, right? This is a big picture concept. So look at inflation and the dollar. These are two things that really affect the direction of the market. Okay. So this looks a little bit complicated, but we're just going to talk about it kind of at a high level, right? We're going back here to the early 1920s. Okay. We were in a deflationary cycle, meaning we're looking at the 10-year treasury yield. Okay. The 10-year treasury yield tends to track the level of inflation. So when you're in a deflationary cycle, yield is going down. That's good for stocks. Okay. When yield is going up, it's generally bad for stocks. So a good way to track it is the 50 line on relative strength. When you're below that line, yield is falling. When yield falls, the cost to borrow money gets cheaper, right? The yield that you have to pay, imagine like your credit card. The yield that you have to pay in your credit card comes down so you can borrow more money. When you're in an inflationary cycle, yields are going up. It's more expensive to borrow. Okay. It's more expensive for companies, for countries, and for individuals. And so when we're above the 50 line in relative strength on the 10-year yield, and this is a 3-month, right? Each one of these ticks is 3 months. So it's a very long-term chart. But when you're above the 50 line in relative strength, yield is going up. It's generally a bad time for stocks. So we, in our lifetimes, our, memorable lifetime, 1985, right? Yield peaked back here in 1982 or so, and it's been falling for 40 plus years. So we've been in this deflationary cycle for the last 40 something years. And that changed when we did a big tick above that the 50 line in relative strength, and the Fed started raising rates a couple years ago. Okay, took us out of this deflationary channel, and now we're back into a long-term inflation cycle. So what does that mean in the big scheme of things? If this continues, it doesn't have to go straight up from here. It can come down quite a bit, and it probably will. because the Fed, well, the administration wants rates to come down. So if they get what they want, rates come down, right? We had a spike up, rates come down to some level, say it's 2%. Say the Fed gets their 2% target rate. And then we start working our way back up, right? But as long as we're above this 50 line going forward, rates are rising. It gets more expensive to take a loan for a house, a car, send your kids to college. The dollar becomes less valuable, right? Everything's inflating. Along with inflation, assets go up in price, right? So stocks can go up during inflationary periods. But it's really important to understand the cycle that we're in, and we just began a new inflationary cycle. So in the short term, yeah, can rates come down and the stock market goes up and we're in this big boom cycle for a minute? Yes, that can absolutely happen. But if we are entering this new uptrend on an inflationary cycle, all things being equal, the market's going to struggle. So that's a really big picture way of looking at it.
Yeah, and one thing that we're not able to show on that chart is another possibility that could happen, and it's going to be very hard to see, and that's going to be a sideways movement, right? I think personally that sort of thing scares me more than a deflationary cycle or inflation cycle, right? If there's a trend, it's much easier to respond to it. Like if you can see the trend, if you see the trend is going up, great. If you see the trend is going down, great. The hardest thing to do in any situation is when the trend is going sideways. And you won't see it. This is a 3-month tick. Is that what you said?
Yes, 3 months.
Yeah. So just imagine one tick is 3 months, right? So is it going to show up in a year? Is it going to show up in 2 years? I think it would probably take about 2 years to kind of see that it's going sideways. And so in that little, I'm going to take it back to the chart, Jerry, so you can kind of show them what that would look like. Show them what it would look like if it went down almost as much as it went up here in this last kind of move up, and then it kind of went back up again, right? So sort of a zigzag, a start of a sideways movement. Are you able to do that?
Yeah, as long as we don't, long as we don't get below that low
exactly.
in, yeah, that's right.
And so take that back up again, right? And now back down, and then so you're in this little wiggle, right? That has never been a situation, as you could see in that chart. If you zoomed in, you could probably find some, right? But looking this far out, where you can see these long-term, that to me is the scariest situation, because we get in this kind of back and forth, so maybe it takes 2 administrations for this to happen. I don't know. But all I'm saying is I want to point out that is an option, and it's also happened a lot more recently in individual stocks and in things like the S&P 500. If you go back a ways, not too far back, you'll see that we had one of the longest sideways movements that we've had in decades. And so that makes it very, very difficult to sort of just like ride the wave, right? So theoretically, if you're in something when that starts happening, you stay in until it shakes out of that sideways. If you're out, you stay out. That sounds easy, but it's a whole lot harder to actually do, because when you're zooming in and looking at it day to day, week to week, you're going crazy. And so I just wanted to point that out, that it doesn't always go up and down. It sometimes goes sideways, and we just haven't seen as much of it. And I think we're going to see more of it, because most of what we're looking at nowadays has this sort of kind of the push and pull, and what that creates sideways movement. Right? Push and a long-term push, whether it's up or down, that's different. What we're seeing is kind of this back and forth churn that makes it look like more of sideways than a correction.
There are so many people that have different ideas of where things are going. We could absolutely see something like this. It could go sideways. There's no doubt about it. It could go sideways. And, to your point, each one of these ticks is 3 months. So something like this takes us out, into the 2040s, 2050s, and it can happen. There are a lot of really good analysts that are calling for big spikes in inflation and then deflation and then inflation again, for all kinds of different reasons. All I'm saying is it's good to have a big picture perspective of this thing so you understand the environment that you're operating in.
Yeah, 100%. And also, don't stop looking at it. Right? Don't let this be the last time you look at that chart. If you're an investor, this should be in your stack of charts. You could zoom in a little bit, to help yourself. I wouldn't zoom in too much, but meaning you go from like a month instead of 3 months. But this chart is extremely useful in looking at long-term trends. And there is no question, if you look at that chart and take it for what it is right now, that we are starting an inflation cycle. But that doesn't mean it couldn't change. I think it would take a lot stronger shift in a lot of things for this to turn around and go deflationary, right? I think that's probably just math. It is a lot more probable that it's going to go sideways or up.
Yeah. I mean, there's only so far theoretically, right? I mean, in the United States a couple of years ago, we did not have a negative inflation rate. There were countries in Europe that did have a negative inflation rate, but here's zero, right? And we were basically at it. So how much lower can you go? I mean, like you said, it's basically the math. Can we come down here and keep going down? I don't know. I don't know how you get below zero for any significant amount of time, but everything is, at this point in the game, I mean, anything is possible.
We'll have bigger problems if that happens.
Yeah. All right. So the next one is the dollar. Okay. The dollar is at this place that is really, really important. The dollar has a big impact on what happens with the market. And I have the dollar chart, the dollar index up here, and the S&P 500 down here. Okay. This is a weekly chart. So every time the dollar has gotten down to this level, right, it's found support on this long-term trend line going back to, call it 2008 or 2011, however you want to look at it. So the dollar right now is at a really important place. History would suggest that we put in a bottom in the dollar a month or two ago. And now the dollar is going to begin to move back up, right? That would be consistent with the chart. Doesn't mean it has to happen, but that would be consistent with what historically has happened since the bottom in 2008. When the dollar is going up, okay, 2008 is the best example. The dollar spikes up, the market spikes down. Okay. All things being equal, this is just one thing. The dollar is just one input, but it's a pretty important one. When the dollar is going down, the market likes that. Okay. When the dollar is going up, the market does not like that. Doesn't mean it crashes, but it doesn't like it. It goes sideways to down. Okay. So if you remember back in 2022, this doesn't look like very much on this chart, but that was a pretty big dip we had in 2022 because the dollar was going through the roof. Okay. When the dollar goes up, stocks do not tend to do well. We just had a big decline in the dollar since the beginning of this year. That's what is driving this rally that we've had, since the beginning of the year. If the dollar finds support here and starts moving higher, it's going to be very difficult for the S&P to continue moving higher. If the dollar declines, right, we had this little consolidation and the dollar continues to drop down, then yeah, you're going to get a big rally in the S&P because the S&P really, all things being equal, the S&P really likes a less expensive dollar. Okay. So this level that we're at, the only reason I'm pointing it out is because it's at a potential transition point. So if we get down here somewhere and the downtrend, this downtrend continues, S&P likely keeps going. If the dollar holds support there and reverses and starts moving up, like it has done historically back to 2008, the S&P is under pressure. Doesn't mean it's going to collapse, just means it's under pressure. Okay. So those are big picture concepts, okay? So if we want to take a look at where the TSP is kind of headed on a much more short-term basis, this is a weekly chart of the C fund, and we put in a 50 period. In this case, it's a week, so it's a 50-week moving average line. Right? All that is averaging out the last 50 weeks and plotting it on a line. And it's pretty useful because you can see, generally speaking, when we come down, price comes down to that 50-week moving average line, it tends to find support there. When it's below that line, it acts as resistance, right? This was COVID. It blew right through it. Came much further down, and once it gets back above it, consolidates a little bit, and then we're off and running, right? Everything's good. In 2022, a little bit of an overshoot there, but it acts as resistance until price can get back above it, and then we're good. And then the summer correction in 23 came down to that level, found support, broke through it right there in April, right? That big decline we had in April comes down to that line, churns there for a few weeks, and then collapsed through it again, right? And now we gapped up through it, and we're off and moving, right? So from a big picture perspective, the 50 period moving average, in this case, a 50-week moving average, is really helpful to see the overall trend. And right now, obviously, the overall trend in the S&P 500 is up. Questions?
As usual, if you have any questions, you can put them in the comments section wherever you find the video. Not only questions, but comments. All right, give us some feedback. Again, we're going to be doing the podcast in this format probably for the indefinite future, I guess. And that way we can travel and not be killing ourselves to try to put it together. But we always love feedback. So if you guys have any feedback or any questions or anything, make sure to put them in the comments section. Also, if you want more of this, then go to our website, growbytsp.com. We go a lot deeper each week into all the TSP funds. We have models that we track the funds and do different allocations. So a lot of good stuff on the website. Hope you guys are having a great weekend, and hope you have a great week.
See you next week.